All right, let's dive right into this explainer. If you've been stuck dealing with legacy accounting systems, you know exactly what it's like. It's kind of like constantly patching up a leaky roof, right? Keeping that ledger aligned with all these ever-changing statutory rules is just exhausting. Well, today, we are going to completely unpack the 2026 UK financial reporting templates inside osFinancials and TurboCASH. We're going to see how this totally revamped system acts as a super rigid, fail-safe blueprint to keep your data beautifully structured, perfectly compliant, and honestly, ready for literally any audit thrown your way. To keep things perfectly on track, here's our roadmap. First, we'll look at the 2026 master template. Second, assets, liabilities, and liquidity. Third is the -900 catch-all protocol. Fourth, handling prior period adjustments. And finally, UK VAR return mapping. Let's jump into Section 1, the 2026 master template, laying the foundation. So the major game changer here is the shift to this specific template you're seeing, the 4EN UK sole proprietor. And let me tell you, this is a massive upgrade from those old legacy setups. It forces this incredibly rigid, structured architecture, specifically a 4-digit main account and a 3-digit sub-account system. So instead of the old Wild West where users could just randomly spin up accounts wherever they felt like it, this blueprint totally locks down the hierarchy. It ensures that every single transaction you make automatically rolls up into the exact right reporting category. No guesswork involved.
Now, the really crucial point here is that this isn't just a simple software update. It's actually a full localization that binds your accounts directly to IFRS or International Financial Reporting Standards. And yes, that means we're finally saying goodbye to outdated terminology. Those old UK habits of saying debtors and creditors, they are officially out, replaced with the globally recognized customers and suppliers. It basically guarantees your ledger is speaking the exact same language as international auditors and modern banks.
Moving right along to Section 2, assets, liabilities, and liquidity, framing the walls. Check out this concept called the order of permanence. This is a highly specific presentation style that's strictly followed in the UK and South African templates. Unlike some methods where you'd list your most liquid cash right at the top, here you are required to list non-current items first. That means your long-term structural assets. Think property, plant, equipment, or long-term borrowings. They absolutely must appear before the highly liquid stuff like short-term cash or fast-approaching debts. Why? Well, it gives anyone looking at the books an immediate, true picture of the long-term solvency of the business before they even bother looking at the day-to-day cash flow. And as you'll see, IFRS 9 and IAS 1 dictate this structure all the way down to the actual account codes. Take account G280000 for long-term borrowings. It is totally separated from G260000 for short-term borrowings. There is this strict 12-month boundary rigidly separating long-term debt from current short-term obligations. This setup guarantees that your balance sheet natively reflects your true liquidity. No more messy manual recalculations at year-end. All right, let's hit Section 3, the 900 catch-all protocol, organizing the junk drawers. Okay, let's be real. Every business has those miscellaneous expenses or quirky assets that just don't fit perfectly into a neat little box. We accountants affectionately call these our junk drawers. But if you leave them unchecked, these other categories can literally destroy a financial report. So, osFinancials came up with 3 golden rules for the new 900 sub-accounts. First, naming consistency. They always have to start with the word other, followed by the parent group name. Second, strict materiality standards. And third, dodging the total account trap, which ensures symmetrical placeholders exist for every major group without completely breaking the software's reporting engine. Let's zoom in on that second rule for a second, because it's actually massive. We call it the 5% rule. Basically, if your other account, let's say other inventory, balloons up and goes past 5% of your total assets or revenue, IFRS materiality standards step in and demand action. At that point, you can no longer hide it in the catch-all drawer. You literally have to pull it out of the 900 bucket and give it its very own specific named G-code. It totally forces clarity and stops companies from hiding massive liabilities or, really weird revenue streams under the vague umbrella of miscellaneous. You can see how this plays out here where other inventory items maps straight to G1200900. But here is the technical catch, and this goes back to that third golden rule. While you absolutely need these lines, you cannot, ever, set a 900 account as a group header in the software. They have to be flagged as detail or postable accounts.
If you accidentally set one as a header, the whole reporting engine fails to calculate the other portion of your totals. And boom, your balance sheet breaks instantly. Definitely something you want to avoid.
On to Section 4, handling prior period adjustments, fixing the plumbing. So, imagine this. You suddenly discover a massive depreciation error from like 2 years ago. The immediate temptation is to just slap a journal entry into today's expenses and be done with it, right? Well, International Accounting Standard 8, or IAS 8, strictly forbids hiding material prior period errors in today's operating expenses. If you do that, you totally warp your current profit and loss statement, making this year's performance look artificially terrible, or conversely, artificially amazing. The rules say it absolutely must be corrected retrospectively. And the 2026 template handles that exact nightmare scenario so elegantly. Look at account G30000. It is dedicated exclusively to prior period accounting adjustments. So rather than taking a hit on a current expense line, this account safely routes those retrospective corrections directly into equity, specifically into retained earnings. This means your current profit and loss statement stays perfectly clean and untainted, while the balance sheet just absorbs that historical shock correctly. It's a total lifesaver. And finally, Section 5, UK VAT return mapping. Putting on the roof. Okay, anyone who has ever had to file a VAT return knows the sheer pain of manually calculating which transactions go into which statutory box. It's a headache. But here, the software's T-codes are meticulously hardwired to match the exact boxes on your UK VAT return. It natively separates the standard 20% rate from the reduced 5% rate for things like domestic fuel, and the 0% rate for books or children's clothes. It even bakes in T2416 for postponed VAT accounting, handling all that complex modern logic required for UK imports post-Brexit. It's really all about automation through strict structure. By aligning a code like T240030 directly to Section 24 of the Value-Added Tax Act of 1994, osFinancials is automating your statutory compliance right at the transaction level. Seriously, every single time an invoice is raised or a bill gets paid, the template routes the tax straight to the precise current liability account. This makes absolutely sure that your quarter-end reporting to HMRC is mathematically flawless right out of the gate. So we've seen how this 2026 blueprint locks in those strict liquidity orders, manages the chaos of other accounts with the 900 protocol, shields your P&L using IAS 8 compliance, and hardwires your UK VAT returns. The days of flexible, messy ledgers, yeah, they are completely over. Modern financial standards demand absolute precision. So as you look at your own ledger today, you really got to ask yourself, is your accounting foundation truly solid enough to survive an IFRS audit, or is it time to adopt the blueprint of balance?